say good afternoon. I'm Colleen Ryan, and I'm the Consulting Executive Director for the New York State CDFI Coalition. For more than 2 decades, this nonprofit association has been the organizer and catalyst for important initiatives that help CDFIs and the communities they serve. The 2020 CDFI Friday series was supposed to be our 11th annual statewide conference with the theme New York State CDFIs Collaborating for Impact. But even though we can't meet in person, it's a great pleasure to welcome you to this online gathering. Allow me to take a moment to thank the Board of Directors of the New York State CDFI Coalition, especially the coordinators of this panel, Howard Banker and Karen Haycox, who you'll meet in a moment. I'm very grateful for their support. I'd also like to thank our sponsors for their understanding as we made the move from traditional to virtual conference. We are grateful to JP Morgan Chase, Wells Fargo, M&T Bank, Amalgamated Bank, Capital One, B&B, Citizens Bank, Community Preservation Corporation, Hanover Bank, Ponce Bank, TD Bank, Valley, and Wood Forest National Bank for their support. So today, as we have for several weeks starting in September, we will gather online with supporters from around the state to share ideas, learn about the latest lending and program innovations, and enjoy the company of people with a shared passion. We have a couple of options for Q&A at the end of the panel. You can either use the chat feature built into Zoom, which some people are already using, or if it's easier for you, just send your question to info@nyscdfi.org. You can feel free to send questions throughout the talk, and we'll do our best to get to as many as we can. If you're not already a member, please consider joining your colleagues from around the state and help the coalition develop its agenda for 2021. With a track record of some 4 decades of providing capital to low-income communities, New York State CDFIs have a legacy of success to draw upon. And as the need for our services becomes more evident than ever, we're looking forward to working with you to keep up with the expectations of our clients and the needs of the underserved. We are so delighted to welcome our panelists to discuss uncovering opportunities for housing preservation together. When trying to preserve affordable housing, no two communities or efforts are alike. Before we find out how CDFIs and community partners are joining forces to uncover opportunities for housing preservation, from basements to city blocks, I'll ask each of our panelists to introduce themselves, starting with moderator Karen Haycox. Karen?
Thank you, Colleen. I hope you can hear me. For the benefit of the audience, we are having a series of technical challenges, so bear with us. Welcome to Zoom, and welcome to 2020. We're nearly done. My name is Karen Haycox, and I have the good fortune of being the CEO of Habitat for Humanity New York City. I'm also the president of the Habitat New York City Community Fund, and I serve on the board of the New York State CDFI Coalition. So I want to take this moment before I continue in my introduction just to give a big shout out to Colleen for her hard work on doing this transition. There's been some really evocative and interesting sessions, and we're proud to be part of the big finish here. Habitat made a big move into housing preservation per se some years back. After I joined New York City, I've been with Habitat for, I started when I was 5. You can do the math. I am also fortunate to serve on the community board for the New York City Housing Partnership, and independently I serve on the board of directors for Rainbow Railroad, which is a global organization that focuses on providing LGBTQ individuals around the world with safe pathway from state-sponsored violence. So that's who I am.
Okay. We are going to skip Chris for a moment and go to Katherine. Could you introduce yourself, please?
Sure thing. Hi, my name is Katherine Murtha. I'm a loan officer at Capital Impact Partners. It's a national CDFI with 38 years of experience providing integrated financing solutions so people and communities can reach their highest potential at every stage of life. We're headquartered outside Washington, D.C., but we actually, you may not know, have an office in Midtown Manhattan, out of which we originate loans in New York, New Jersey, and Connecticut. And we have offices in Detroit, Oakland, and Austin, Texas. And I'm excited to be presenting to the New York State CDFI Coalition and hope to collaborate with more New York lenders and meet new partners for loan participations. And just a little bit about me, I've been in CDFIs for 5 years, and I've been underwriting affordable housing preservation loans at Capital Impact for 2 years. I've closed over almost $19 million in affordable housing preservation loans, preserving almost 700 units and participate in working groups with like lenders, developers, and government about ways to do preservation. I've testified before City Council about limited equity co-ops as a preservation tool, and I have talked to governments and foundations about how to set up sort of similar public-private partnerships to preserve affordability in Maryland and Virginia. So hopefully we can, you know, come up with some good ideas for how to help work on preservation in New York as well. Thanks.
That's great. Why don't we go to Chris now, since we seem to have both audio and video at once for a change. So
yes,
let's make hay.
I apologize for taking up a little bit too much space on the screen here. But my name is Christopher Illum. I am the Executive Director for Habitat NYC Community Fund. We are a new fund. We are also members, as Karen said, of the New York State CDFI Coalition, which we are happy and proud members of. Our fund is newer. It has only been certified for a couple of years. I believe it was not this past August, but the August before, we got our certification. And we are the outgrowth of Habitat NYC's preservationist sort of mindset and turn that the org has taken towards making a larger impact in New York City, not just by building, because we recognize we can't build our way out of this, out of the housing crisis that we have, but as a way to preserve affordable housing and spur more permanently affordable housing throughout New York City, and then hopefully throughout New York State, playing a role with the 50 some odd Habitat affiliates throughout New York State. So if we're not lending in your community now, we really do hope to be in the future. Thank you.
Great, thanks. Why don't we go to Akbar, since his mic is open.
Hi everyone, Akbar Rizvi, Chief Lending Officer of Spring Bank. Spring Bank is a community bank that's based in South Bronx. 2 branches in Harlem as well. We're a CDFI, proud member of CDFI, and also a certified B Corp as well. And you know, we pride ourselves in being able to think outside the box. We don't necessarily look to fit our customers into holes and boxes and kind of keep them forward. We're able to kind of look at things on a case-by-case basis and make sense of a transaction. And so in that regard, we were fortunate enough to be able to work with Habitat on a great project, and something that we look forward to talking about today as well.
Great. And last but not least, we'll ask Will to introduce himself.
Thanks. Hi, everyone. My name is Will Spisak. I am the Director of Housing Justice at Chhaya Community Development Corporation. Chhaya is a 20-year-old organization based in Queens, New York, that works to build the housing, stability, and economic well-being of the South Asian and Indo-Caribbean communities in our borough. I'll be talking today more extensively about one of our projects in particular. We do a lot of tenant organizing, housing counseling work, advocacy, so on and so forth. And one area that we've been leading the way on for over a decade is in the area of accessory dwelling units and specifically basement legalization in New York City. For folks who don't know, I'll get into it. Basements are usually illegal, depending on certain situations in New York City. We've been fighting a campaign to legalize it as a source of affordable housing. More about me, just real quick. I have been working as a community organizer and specifically housing advocate for the last decade. Been with Chhaya since 2016, and born and raised in Queens. So I hope to share not just my professional experience, but also a little bit of the personal experience that comes with that. Thank you.
Great. Well, at this point, I'm going to turn it over to the panel. I'm going to mute myself and my video so you can see them all better. And we're going to start with a presentation from Katherine. So I'm going to go away, but I'll be here watching and taking any questions. Again, if you have questions that you don't want to put in the chat, you can send them to info@nyscdfi.org, and I'll come back in at about 1:45, 10:01, and we'll do a little Q&A. Take it away.
Okay, I think I'm sharing. Let me try it again. One second. Okay,
there you are.
There's my screen. Okay, great. So this is talking about a preservation fund that we have in Washington, D.C. that could provide a good framework for how you might do something similar in New York. And I'm going to talk about the way the fund works and also why it was created and the conditions that make it effective. I think there's going to be some similarities. So basically, Capital Impact is has been working on affordable housing across the country for several years, and we've provided $381 million in loans, leveraging $1.5 billion for development, rehab, and preservation of affordability. And 95% of the units that we've preserved are for households that are earning up to 80% of the area median income. So the way this works is the Washington, D.C.'s Department of Housing and Community Development selected CDFIs to manage the fund. So they make grants to us, and then we leverage that with our own capital at a minimum 3-to-1 ratio to make acquisition critical repairs loans. So the way, like an example is, we got our initial grant was $5 million, and then we put $15 million in for a total amount of loans, $20 million to make loans. The way that the loans work is usually they're interest only, up to 4 years, loan term, below market rate interest, up to 125% LTV, and a debt service coverage minimum of 1.1 to 1. So thus far, we've closed 7 loans, preserving 924 units, and one of the loans has been paid off. So why they created the fund, the affordable housing stock in DC was at risk. There's a lot of expiring LIHTC properties, and prices in the area keep going up and up. So the mayor decided to create a task force to investigate ways that DC could preserve and create more affordable housing. So one of the preservation funds, the preservation fund was one of the recommendations of the strike force. So here's the conditions that make it work especially well in DC, and I think there's some conditions that could be kind of parallels in New York. So Tenant Opportunity to Purchase Act is a way of kind of buying time for residents to line up more long-term financing for their properties and prevent properties from disappearing. First Right to Purchase Program and Housing Production Trust Fund are subordinate cash flow loans that come from the city that can be a source of takeout. And then there's tax exemptions on property tax, as well as a transfer and recordation tax that make these projects a little more affordable. A little more on the Tenant Opportunity to Purchase Act. This is a pretty key piece of making preservation work. It's almost all of our deals that we've closed in DC have been what we call TOPA deals. So essentially, when a property comes on, when an owner decides they want to sell a property, they issue a TOPA notice, and the residents have about a year to line up financing to buy the building. So if there's a third-party bid on the property, the tenants have to match that bid. And so either the tenants can choose to form a cooperative, or they can assign their first right to purchase to a developer, and they work with the developer to create a development agreement that says, here's what improvements we want to see in our property. And the tenants also can choose to include some affordability language in there. Our preservation loans, as I mentioned, they can go up to $10 million. We have this higher LTV, flexible, below market rate interest, because we're blending in this grant funding. And the loan term being up to 4 years gives the developer time to line up their refinancing sources. So it's real estate backed. We get a corporate guarantee from all borrowers, and for for-profit developers, any owner over 20% of the owner LLC provides a personal guarantee. And key in this loan fund is that when we close the loan, we record a 10-year covenant that ensures that 50% of units have to be affordable to and occupied by households that are earning up to 80% AMI. So they have to, and this covenant, like obviously if our loans only go up to 4 years, then even after the loans are paid off, the covenant still stands. Although most of the way it works is most of the developers are pursuing some kind of a subsidy as part of their capital stack for a takeout that includes stricter restrictions. And so, like if you're planning on taking out our loan with a LIHTC financing, then you would probably have even stricter affordability than what we have, and that would supersede our 50% at 80% AMI. So some of the types of preservation projects this is best suited for So basically, the residents in DC are in this race against developers who want to snap up the properties and convert them into more expensive either condos or rentals. And so what this does is being able to get this low cost and flexible financing gives them the opportunity to just buy time, hit the pause button on the property disappearing, and they can line up either major rehab financing, or they can form a co-op and come up with some kind of acquisition refinancing, or do critical repairs to improve the NOI of the property, which, like, by the time the loan matures, then they would be better positioned for a more traditional refi. And it can work in, like if there's a desirable neighborhood, but a particular property has a lot of deferred maintenance and high vacancy, and so the price is not too high, so they can preserve it that way. So I have some example projects for you. We've done, I didn't mention this, but the loan fund, we are able to do both subordinate and senior debt. So on some of the bigger projects, basically this was one that had, it's a larger project. So this is 272 units of garden apartments, and it's no longer deed restricted, but mostly all of the tenants are in households that are earning up to 60% AMI, and the seller is a mission-driven for-profit developer, and he realized that the best positioning for the property was to sell it to a nonprofit who could then re-syndicate the tax credits. So the way it worked is there was a senior loan to 70% AMI or 70% LTV, and then we came in with some gap financing, and then the seller came in with seller financing. So the total that our loan was up to 105%, and then with the seller financing, it was 111% LTV. So, this property is currently cash flowing as naturally occurring affordable housing, and then the takeout plan is to use bonds, 4% LIHTC, and then gap financing through this competitive city subordinate debt that's like cash flow loan through the city. And then the second project is totally different. It was a smaller property where the there's high vacancy because of conditions are poor in some of the units, and so they were offline. And so the plan is that we provided this acquisition loan to the tenants association, which is going to form a cooperative, say on their own property, and then they are going to hire a general contractor to make the repairs to the offline units, like that have mold, water damage, other issues. And then once they can get those units occupied again, then they would the property would cash flow better. And so by the time of maturity, it would be able to support a bigger loan. And this, this is it's a somewhat rundown building, obviously, if it has offline units, but the neighborhood is very hot, and it's just got, DC's first Walmart is around the corner, and it's within walking distance of a bunch of schools and bus lines, and it's a little over a mile from the two nearest metro stations. So this, the third-party buyer is usually does condo development, and so it was really poised to flip. And so the current residents, when they chose to form a co-op, this was their way of kind of locking in affordability and also retaining control over their building in their neighborhood, because some of the residents have lived there since the 70s. So this was a tricky one, and we did some interesting structuring on it to mitigate risk. So we had like a sinking fund, so that so basically any cash flows over a certain amount have to go into the sinking fund each year, and then at the time of refi, then they'll have some equity that's saved up that they can use for that. And then also to mitigate risk, we structured a big chunk of the proceeds to be held back and released based on construction inspection reports and achievement of other key milestones, and capitalized interest is held back as well. I underwrote and closed this one during COVID. So I was checking the rent rolls for vacancy, and then also checking in with them on collection status to see like how people were doing in terms of being able to pay their rent. Because DC had a stay-at-home order for 2 months, and so people were furloughed from their jobs, and so it was hard for them, and they had to top their savings to pay rent. But the DC's stay-at-home order was lifted at the end of May, and so people were able to be more stable after that. And like other folks who were on fixed incomes, actually they were able to keep on paying their rent because they kept on receiving their payments. So this is just like some of the sample terms and covenants for the preservation fund. I think it's a really cool tool, and I think it works especially because there is this TOPA law in DC. There is the rent control makes it so that speculative landlords or speculative developers aren't able to bid too high, but it's still like there's a lot of challenges and there's a lot of tricky things that do make it difficult, and so you do have to get kind of creative and flexible with the structuring to make sure that it's lower risk. So that's
Katherine,
the preservation fund.
That was great. That was great. You're getting lots of questions in the chat, actually, and
okay,
I was having questions. I don't know if you could hear me. I didn't realize I wasn't muted because I was muttering. I was going, "Oh, that's really cool." I was curious about. I was curious, and someone in the chat asked this question too. I mean, how do you? How do the development services angle happen? Do you partner? Who does the technical assistance? Who helps organize the tenants? Is that something that you guys take on, or do you have a partner on the ground that you partner with to do that kind of thing?
Yeah, so I guess like a couple other things I wanted to mention about like DC's efforts in preservation. They have a preservation network, and so there's like a preservation catalog that's aggregating data from HUD and DC government and Urban Institute and the census, and they're able to track basically all of the sort of at-risk properties in DC, and each week DC publishes the TOPA notices. So like if there is a property that that an owner wants to sell, they issue this notice that there's like a notice of intent to sell, and so that's every week. And so the DC partners with community-based organizations that are they provide tenant services, and they do give some grant funding to those organizations. So they are checking it every week, and they're proactively reaching out to as many of these properties as they can to just get ahead of it and inform tenants of their rights and educate them on the process of forming a tenants association and help them understand, like, here's our options vis-a-vis forming a co-op or assigning your rights to a developer and who's a good developer, like a friendly developer, that kind of thing. And they have templates for the development agreement also to help protect.
That's great.
The tenant.
Thanks, Katherine. Thanks, Katherine. I think we could talk about this all day because there's a lot of interest as you highlighted around New York City. But we have I want to get to the other team, and then maybe we can kind of unpack some of this because I think there are still some more questions from the guys. But I wonder if we could go to you, Will, and Chhaya, and talk a little bit about about what you guys have got underway underway with Chhaya.
Yeah, sure. Thanks. So yeah, switching gears a little bit, the conversation I'll have with folks is about a campaign which turned into a pilot program, which is aspiring to become a citywide program. And we're trying to figure out now kind of the opportunities for partnership and development, with CDFIs for the future. So I think it's exciting. But yeah, let me start with, if you're familiar with New York City, that housing is typically not very affordable. And if you've had the opportunity to get into the neighborhoods, particularly in the outer boroughs, you'll probably find that the most affordable housing units that you come across or meet folks that are living in are in basement apartments or illegally converted units, informal housing situations across the housing stock. So this is something Chhaya found over 10, 15 years ago when we started counseling clients and organizing tenants that were living in basements, as well as the homeowners that rented out their basements. And we found that many of the low to moderate income homeowners were able to become homeowners because they were able to rent out their basements. To many of them, they didn't know that it was illegal. But that's often the way that they were able to afford their mortgage payments. And likewise, the tenants that were living in illegal basements were living there because it was the most affordable thing they can find. Today, even you find basements at $800, $900. That's very difficult to find in New York City. So this all seemed great, and that seemed like the primary source of affordable housing for a lot of folks. But there are some hidden costs to that. One, there's the health element to it, where a lot of these basements are not up to code, and they are often damp, or don't have good ventilation, don't have good light. And there are a number of other issues that come with it. The second is because these are illegal units, sometimes families are fined by HPD or Department of Buildings, and these fines can add up to really crippling sums. Recently, last couple of months, I worked with a client who amassed $45,000 worth of fines for renting out her basement. As a homeowner, a low-income homeowner, that's unsustainable. And typically what we find are people who are hit with those kind of fines, where they knew it was illegal or not, are put on the fast track to foreclosure, which is unfortunate. So, we started this campaign called Basement Apartments Safe for Everyone, and we place safety at the center of that conversation. But it's really a question of affordable housing. People live in basements. It's a fact in New York City. By our estimates, 114,000 illegal basements are occupied across the 5 boroughs right now, possibly more. And we believe that, we have to recognize that as not just the reality, the lived reality of families, working class families, immigrant families across the city, but also as an opportunity. Here we have built into our city's infrastructure a stock of affordable housing that goes unrecognized, unappreciated, and lacks any form of investment from the sector that we work in. So we see this not just as a problem in terms of substandard housing and potential source of fines and foreclosure for homeowners, but it is really an opportunity for affordable housing. When we did some recent mapping of potential basement units, we found that if we use the model that is currently being used in a pilot program that we're running in East New York, Brooklyn, we could potentially find 200,000 basement apartments that could be converted into legal units across the 5 boroughs. So that was, if I'm not mistaken, the original target of Mayor de Blasio's affordable housing plan, 200,000. So here's 200,000 units that are already built. All they have to do is be brought into safety and code regulation. If we take an expanded model, I'll talk a little bit about what those expanded models look like. We can double that. We found that there could be potentially about 430,000 units in New York City that could be converted. Now, not all of these units should be, right? There are some basements that are just not suitable for habitation. And no matter how much we invest in it, it's just not going to be okay. But think about that universe. There is a universe of 400,000 units that could be converted. But what's the problem, and where is the opportunity for partnership here? The problem stems from what we believe are unnecessary kind of complications and restrictions around bringing these units into, out of the shadows, if you will, and legalizing them. That could be easily mitigated by legislation. So for one thing, for instance, we constantly run into the problem of ceiling height. We've been working on this pilot in East New York, where we're trying to convert 40 units into legal basement apartments. And what we found is that many of the basements have ceiling heights of, say, 7 feet 3 inches, 7 feet 6 inches, something like that. Under the standard code, it would have to be in a basement an 8-foot ceiling. And we know, I'm sure many folks here might know that in many parts of the world, 7-foot ceilings are pretty standard. So we have advocated, and if you live in a single family home, on a single family lot, and want to use a basement as a habitable living space, but not a separate unit, 7-foot ceilings are okay. So we've been advocating that the city change that law to allow for us to legalize a basement with 7-foot ceilings. That would reduce the cost of legalization, because we wouldn't have to either raise the ceiling somehow or dig deeper into the ground in order to get that 8 feet ceiling height ratio. We have pushed back against this, the law that regulates cellars cannot become legal. The difference in New York City between a cellar and a basement is 50% of the floor to ceiling height is under, has to be above ground, so more than 50% rather. So 51% or more of the floor to ceiling height has to be above the curb level. That's considered a basement. If it's less, it's considered a cellar. We just think that's an arbitrary distinction. So there are units that are perfectly livable, perfectly, capable of becoming legal units that could never be because they're just a little too deep in the ground, even though you can still build a window that you can escape in case of a fire or something along those lines. So we've been advocating for those changes. And we believe that with those kind of changes, changing, parking restrictions, floor area ratio, when you convert a cellar to a basement, it adds to the FAR calculations, which we don't think it should because it's already built, right? We're not actually adding more area to the plot of land. So we think with all these changes, it would reduce the costs, right, of renovation without all these unnecessary additional costs that would be added on to legalizing the unit. And you can legalize these units at much cheaper rates per square foot than building new affordable housing, which means this is a great tool for preserving affordable housing in New York City and potentially beyond, right, in using accessory dwelling units in general across the state. So we have also run into one other problem, which is, I think, relevant to this conversation, which is that we find that funders, primarily the banks that, we partner with and work with, just don't understand what we're doing when it comes to basements. They are hesitant to lend to a homeowner to refinance for these renovations because this is new territory, because this is still up in the air in terms of what the legislation will legalize and will not. So that is very much something that we think is an area where CDFIs and community groups like Chhaya can work together in terms of finding ways to fund those opportunities. And I'm very interested to hear what other panelists have to say around how we might be able to partner on something like that.
Thank you for that. We're really excited about ADUs. We're really excited about the TOPA conversation that happened, that Katherine brought to the table. We're running short on time, so I want to jump over to Chris at Habitat New York City, and Chris is going to also tie in an interesting collaboration that we had with our partners at Springbank. So Chris, do you want to try and maximize our time because I'd like to save some time for questions at the end. We're getting some questions from the chat. So yes. Chris, take it away.
Yes. Sure, I'll be as quick as possible. I just wanted to quickly say about just transition from ADUs. I think this is a really exciting opportunity with the legalization, with the work that you guys are doing in Queens. I believe our two organizations are signing on, as well as others, to some statewide legislation. So I think that that's a real space that we should really look at and potentially think about as this New York State CDFI coalition. And it would be great if we had some of the sources of funding and TOPA and those policy changes in New York City, and some of those are on the way. But I did want to focus on, notwithstanding this amazing fund that you guys have in DC, some of the work that we're doing that is not totally dissimilar from the preservation work that we've already heard about. And that involves a limited equity cooperative, which in New York City and New York State is a wonderful resource and a fantastic structure for home ownership for LMI communities. To be honest, it could be expanded. There's a lot of power in the limited equity co-op. In particular, this building, was created in the 80s. It is, I believe, Akbar, I don't have the number in front of me, but I think it was like 60 or 40 to 60 some odd units that had suffered some real abandonment, not unheard of in the HGFC community, particularly in certain neighborhoods. And, I think this goes back to some of the points that were made, is that just how important technical assistance is, whether it's coming from capital impact partners or the people on the ground in DC, or it's coming from our partners and great community org CDCs in Queens with Chhaya, or coming from Habitat, or even coming from Springbank, which is a partner on this deal. where we were able to, along with an organization called UHAB, the Urban Homesteading Assistance Board, had been working with this co-op for some time to help them really get a handle and a pathway back to stability. And I think that that's the real key, if anything else, is that the CDFI has a real, CDFIs generally have a real opportunity through development services and financing and partnerships with whether they be mission-oriented lenders like Spring Bank, which is a great partner, or they be even commercial lenders, to step in and use our expertise on the ground to stabilize those buildings. I will simply state, and then I'll turn it over to Akbar to explain sort of his point of view, but I think that, and I don't want to put words in your mouth, Akbar, but I think that these kinds of partnerships, the lending, the technical assistance, are the things that make deals like the one in the South Bronx worthwhile. So maybe, Akbar, if you want to lay out your point of view from Spring Banks, how we got brought in, and then we can have a quick back and forth and turn it over. I think we have like 5 minutes.
Sure, my pleasure.
Maybe 6. You have 6.
All right, okay, let's do it. So it was a very interesting loan request. I talked a little bit earlier about being able to look at transactions outside of the box, and the loan that we worked on was certainly within that fold. As a lender, we'll look at proceeds, we'll look at how those proceeds are used, what is it that the client needs, and how we can help. And so in this circumstance, when you talk about partnerships, it was a catch-22 kind of situation where the HDFC could not move forward with UHAB funding unless it brought back its water bill current. You know, when a bank would look at something like that, where you talk about the HDFC being mismanaged for a number of years, the water bill was somewhere around the lines of 250,000 plus, real estate taxes past due. This was a bad situation for the tenants that were trying to do the right thing and preserve their units, preserve their housing. And so Habitat was able to come in and provide that technical assistance to the detail of being able to make changes to the building to make it more energy efficient. Those cost savings would help them moving forward. It was complex in the sense that you never want to walk into a transaction where all of these things are past due, but once you started taking it piece by piece and working with our partners, working with Chris at Habitat, working with UHAB, and understanding the different scopes and how everything would work together was what allowed us to be able to move forward. This was our first time working with Habitat, and so my advice was listen, learn, trust your partners. As a community bank, we did go ahead and do the site inspections. We walked through the property. We met with the management company that was now managing the building and felt comfortable with them, assessed their background and their ability in being able to manage a project like that. And so, you know, it was something that within a short period of time, we were able to complete. And it's been, I want to say, about a year now, and, you know, knock on wood, no issues. It looks like they're going in the right direction. And as you stated earlier, in the Bronx and other areas, there are lots of HDFCs that have had some difficult times, some bad apples, some bad management companies that do need additional support like that. So, you know, the other restrictions were legal lending limits. So we were able to come in and kind of help complete that for $450,000. So, you know, if there are other CDFIs that have those limitations on loan amounts, we can help in that regard as well.
Yeah, yeah, I think that's, oh, sorry.
No, I was going to say that.
Okay, I think that real quick, I think that, you know, the key point about leveraging, you know, not only relationships and partnerships, but dollars is just real quick on the numbers is, you know, the fund and Spring Bank came in around, maybe around $500,000, a little bit over, I think it was 515 or something, 525. And that leveraged from the city an investment of $1.5 million in the greenhouse and preservation program. So for the stabilization and energy efficiency that will make them more affordable in the long term, but it also finally unlocked about $3.5 million in tax forgiveness under the Article 11 program, retroactive, as well as the 2001 tax forgiveness policy, local law that was passed in 2001. So with all of those things coming into place, you're really looking at, you know, for a little bit over $500,000 worth of private debt, along with that technical assistance, you know, a investment of around $5 million from New York City. So it is this exact kind of partnerships this kind of technical assistance, this kind of development services for these specific asset classes and the people who live within them is where we're really seeing, at least so far on the ground, where change can happen. With what Katherine had highlighted is definitely something to strive for in New York City, definitely something we want to see in New York State. So with that, I will stop talking and turn it over to whoever's next.
The more unique we think we are, the more the more alike we actually are. I mean, there's so much going on. We're really excited about the TOPA plan for New York City. I just wanted to say about that specific deal with Springbank. There is a resource available to the participants in the webinar that we can share after the fact if you'd like. We're going to obviously redact the address and a couple of the confidential factors, but there's a really interesting pro forma really that goes along with that. So reach out to Colleen, the organizer of the conference, and we can get that to you after the fact if you'd like as a resource. There was a question in the chat about new market tax credits as a source of funding, and it's a point of interest for me. Habitat for Humanity in New York City, Habitat for Humanity across the U.S. has been really successful in leveraging new market tax credits for new home construction. But I think there was a question in the chat about whether any of us here had been able to tap into new market tax credits as a source for our preservation or construction efforts. I know the answer for Habitat New York City is not yet. I wondered about Katherine or Will or Akbar, if you've been successful at all or engaged in the new market tax credit space. Anybody got anything there?
I can go first. I know it's not exploring, but haven't yet been able to start yet.
Yeah, just curious. It's something that that I'm really excited about as an opportunity. So,
actually, I have
where do we go?
A question that came in, and this is more going back to the resiliency and kind of green tax credits. Someone had a question. This is more for Will, I think, about concerns about flooding for basement apartments. Are there particular climate change concerns that weren't there when you started this campaign that you now have to take into consideration?
Sorry, yes. Yeah, great question. And that's certainly something that we've been thinking about through the whole campaign process. For instance, with the pilot program that we're working on in Brooklyn, we use the floodplain and the 100-year floodplain as a boundary that we would not allow any basement legalization to happen on. So that's always something that we take in consideration. I could share a link. I think I could do that to everyone here. If folks want to look more into this, one of our partners on the campaign is the Pratt Center. And we worked on a mapping tool together where you can look at, a map of New York City and see the entire potential universe of basement apartments, and then add in other features. I believe the floodplain is one of them. So you can see where certain neighborhoods might be kind of cut off from this opportunity if they're too close to the floodplain. But in terms of other areas, could be a good opportunity to build or preserve rather affordable housing. So yeah, definitely something to consider.
Hey, Chris, there's another question in the chat that's really interesting that maybe we can dive into, and it's around talking about this as a strategy for smaller 2 to 4 family units. I mean, we've got some stuff in our pipeline that is a really interesting approach for some of these smaller buildings.
Sure. Yeah, we are working on and hope to be launching, well, we're very close to launching a product that is solely focused on, and it's a collaboration through a few different agencies and organizations to help support naturally occurring affordable housing, really focusing on the small landlord, the small owner who is living in maybe a 1 to 4 or even a 10-unit family-owned building, where they're not large landlords, they're not having huge portfolios. This is really their main investment. This group of development, these group of buildings tend to be located really on the margins of what I call the displacement zone, or where these buildings could really be lost, where gentrification is really happening, and the displacement is happening. So we have a tiered approach where it's upfront 100% development service technical assistance to really get a picture of what the landscape is, and then where every individual owner is, where they can be met with a series of services or a menu of services. And then the fund steps in where appropriate on this longer path to really getting, and this is a unique thing about New York City, which may not exist in every place in our state. New York City does have cash of its own to spend on these kinds of projects. So really it's more of a longer continuum where the fund steps in with emergency capital to maybe fix a roof, fix a boiler, or rehab a unit or two that is leading to, as said before, this lack of cash flow, this real crunch that potentially could lose this building. And then in turn, putting them on the longer path for city investment and regulation. So getting those buildings under a regulatory agreement with the sustainable, affordable capital that the city itself can offer, along with this technical assistance, really giving them a longer roadmap to sustainability, and hopefully in turn benefiting really the in many cases long-term residents of these disinvested, naturally occurring affordable housing units on these sort of periphery of these gentrifying neighborhoods.
Well, along those lines, Chris, this is for everyone, but another question came in that it's kind of a good pivot from this. Legalizing additional dwelling units will increase the market value and property taxes of these smaller properties. In New York City, there's an issue with the way property taxes are being assessed. How will this impact your campaign to legalize basement apartments, but also what you're talking about, Chris, through Habitat? How will homeowners be financially impacted? Have at it.
Yeah, I could start real quick on that. So one of the things that we've talked about in the base campaign is trying to mitigate for this issue. We want to make sure that basement legalization doesn't lead to the problems with keeping up with your tax payments and getting on the tax lien sale list and all that kind of stuff. So we've talked about potential tools for doing that, including providing some kind of property tax abatement that's tied to the affordability of the basement unit as a tool to incentivize deep affordability in neighborhoods, as well as prevent this impacting homeowners in any kind of unintended negative way.
Yeah, and for our work,
make a pitch for.
Yeah, for our work, we're where possible and always connected with the city. There is a tax abatement associated with this regulation because there's always benefit and restriction go together. I will say that it is something that we are thinking about as we expand from New York City into our neighboring communities north and potentially around New York State, which is the goal for the Habitat NYC Fund, which is to lend statewide. So that is something that we're discussing, something we've been speaking with different partners and even the folks that Will and I were talking about a little bit before around the policy that we've all signed on to that hopefully will have an impact around ADU development statewide.
I feel like I wanted to give, thank you, Chris. I was going to make a pitch for community land trusts, of course, as well, because one of the things that Habitat for Humanity is also a founding partner in Interborough Community Land Trust, which is active in all of the boroughs of New York City, and it's a strategy that we're deploying. We actually finally have the land trust is after much work. But I feel like we the New Yorkers have really begun to talk a lot about New York. Katherine, I wanted to give you kind of a last shot at adding anything from your perspective, and also Akbar, if there are pieces that you wanted to share with the team before we're getting close to adjourning here. I just wanted to give you guys a chance for some final thoughts. Katherine, you want to go first?
Sure. Yeah, I just wanted to say, if you're trying to work on developing something like this for New York, one of the things to bear in mind is, even though this fund is possible because we're getting grant funding from the city's not providing a guarantee on takeout. So they're not saying, if you provide a loan through the preservation fund, we're definitely going to come and help take it out with, Housing Production Trust Fund or other monies. And so you have to kind of it can be a little frustrating because you're pushing the developer to come up with a lot of backup plans, but it probably makes the most sense because the city only has so much money. And so I think it's the same with you, if the takeout involves, basically any financing that's going to have a gap, like you have to push the developer, like at the time of acquisition, really hard on like what are the different takeouts that they're going to be able to come up with, and like what's the equity going to come from at the end of the 4-year term, and like hopefully giving it kind of a long term and doing the like very low interest and making it interest only kind of gives time for things to stabilize and kind of reduce that equity gap, but it still is like, it's really important and it's hard. And I know it's hard for the developers. I'm not saying it's like you guys have an easy job. So that was one last thought that I had that I wanted to throw out there.
That's great, Katherine. Thank you. And thank you for being here. Akbar, anything to add in terms of Springbank? I mean, we are so proud of that partnership that we worked on together. I wanted to make sure that you, if you had any final thoughts relative to the housing sector and how you guys are currently working and looking to work in the future.
Absolutely. We would welcome the opportunity to be able to do something like that again. I think that was a great learning experience for us as well in terms of the different programs that are available. And so we know that there are sometimes loan limitations for CDFIs up to 250, maybe less. And to think of us as a good partner and being able to look at those transactions as well, we would welcome that opportunity. And it doesn't have to be anything concrete. If there's any questions or preliminary, we'd always be happy to speak. It was a great product.
That's great.
We'd like to do.
Yeah. If I could just say one thing, which is which is the overarching, I think, theme, even though it might have been disjointed of this whole panel, is that it's really nice the CDFI community is really focused on impact and is focused on partnership and is leaning into each other around how we solve these issues, because sort of as Karen highlighted before, what's happening in DC is happening here. We can learn from each other. And I just want to say that, Springbank was a great partner for us as well. And thank you, Akbar, for saying such nice things about us. But really, all of this is just groundwork for the opportunities for partnership for impact in the future. So if there's any ever questions or any around New York State, or there's anything going on, we're always happy to talk, even if we can't play a role directly. I think all of our perspectives are useful.
I think what's true too, Chris, is also that the lending, we focus on entity-to-entity lending currently, and we often are looking at partners who can do lending to individuals, or even affordable mortgage products that we can't do. So so there's always creativity relative to the products that are required to get one project done too. So,
well, this is a great way to wrap up our 2020 virtual conference series talking about collaborating for impact, because that's what it's all about. So I really want to thank everyone who's been part of this series, especially today, Katherine and Karen and Chris and Akbar and Will. Thank you for your time, for your expertise, and for your generosity with sharing all this great information. You can find links of recordings of our previous events, and soon this one, on our website, the CDFI Coalition website at www.nyscdfi.org. So for now, thank you all for your participation. Stay safe, be well, and we'll see you in 2021. Thanks very much.
Thanks, everyone. Kudos, Colleen. Thank you.
Thank you. Thank you, Colleen.
Thanks, everybody.